This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long.
Well, good afternoon in my case. Good late evening in my case.
Late evening for you. A little earlier here. As part of our ongoing series on financial repression, I have Dr. Steve Keen joining us from London. Steve is an Australian economist and author. He was formerly an associate professor of economics at the University of Western Sydney and is currently, I believe, a professor and head at the Kingston University in London. Is that not true, Steve?
That's correct. Actually, I ended up being professor at Western Sydney before they shut their economics department down, so got to the top of the pile over there, and now I'm running the show in Kingston, London.
Are you enjoying it?
I am. It's Kingston's an unusual university because economics is dominated by a very narrow. It's hard to think of a decent term for people who haven't been exposed to economics before, but very doctrinaire vision of how the world operates, a very stylized view. And there's been critics of this view for at least a century. And as it happens, the critics tend to get positions in low-ranking universities. And what it means, in my point of view, ironically, is that if you actually want a good education in economics, you don't go to a good university, because the good university is dominated by the very narrow sect. And the wider range of thought from both the politically wide spectrum and also analytically more diverse occurs at the lower ranking universities, and Kingston is one of those classic universities.
I've had a lot of guests on that, by coincidence, are of the Austrian School, and would echo the same thing. And some of them in the difficulties they had even studying it. And most of them had to be self-taught in that particular school. Do you consider yourself an Austrian economist?
No, I consider myself, I see some strengths in the Austrian School. The Austrian School focuses upon a couple of issues that I think are extremely important. So the mainstream, very narrow doctrinaire school that dominates the profession, which represents about 85% of economists, work with economic models that assume or impose the belief that the economy is in equilibrium. Now, it never is, it never will be, and if it was, we wouldn't even know it was there to begin with. And the Austrian perspective is to say the economy is always out of equilibrium, and in fact they see that as part of the creative force of capitalism, that the fact that you're not in an ideal situation means entrepreneurs can spot potential advantages for innovation and new products and so on, and that's what they see as part of the creative force of capitalism, and that I agree with them on that point. They also argued that we simply don't know everything about not only do we know nothing about the future, we know very little about the present, and our knowledge is quite diverse and fragmented. And that's the vision that I agree with, whereas the dominant neoclassical school says, let's assume we know everything about the present. And not only that, let's assume we have a model that lets us predict the future accurately. They call this rational expectations, but the way they define it is to say that people have a model of the real world, which is an accurate model, that therefore lets them predict the future. And if you told somebody that that's what a person had, they'd say, oh, what that person has is the gift of prophecy. So what they call rational expectations is actually prophetic expectations. So the Austrians regard that as nonsense, and so do I. And then also the Austrians have a strong focus upon the role of the finance sector, which I agree with as well. But I differ with them on their what's called theory of value. They have a utility-based vision of how you should start analysing the economy, and I think that's been shown to be analytically weak by failings of the neoclassical school. And they also tend to think you're not too far from equilibrium, and they borrow a lot of the tools from the neoclassical school, and I think those tools have been shown to be false. So I have overlaps with the Austrians, and Hyman Minsky, whom I'm seen as being a developer of Hyman Minsky's views. Minsky was trained by Joseph Schumpeter. So there's definitely a bridge to the Austrians there, but I'm not on the same side of the river.
Appreciate that. Steve, we're here to talk about the macroprudential strategy, policy of financial repression. Could you describe it, define it in your words for our listeners?
Well, I think often when they say financial repression, they actually see the central banks as pushing down the rate of interest and squeezing the income earned by people who have financial assets. I don't regard it that way at all. What I see it as is the reflection of the growth and the level of private debt in the economy, which has gone from America's case from something like about 25% of GDP back at the end of the Second World War up to 170% of GDP, so increasing by a factor of almost 7 from 1945 to 2007, 2008. That growth in the debt burden is actually what I think has driven the behaviour of central banks, even though they haven't even been aware of the growth in the level of debt. So to me, if I had to say what financial repression is, it's an excessive weight of private debt crushing the economy. And everything else I see as a result of that, including low interest rates and also quantitative easing by the central banks and so on, being their badly thought out response to a crisis that they caused in a sense by ignoring the growth in private debt, but they're not even aware that's the cause of the crisis.
Interesting perception on that. So you don't see it as a clear strategy or policy that they fully understand, that they're really reacting to the current situation, and therefore things like pushing hard on inflation at goals of 2%, of negative real interest rates, these kinds of things are nothing more than reactive.
Yeah, they really, very, very few of the central banks have any clue at all. And I think if anybody thinks that, they think the central banks know what they're doing, all you've got to do is read the minutes of the Federal Reserve. And
Enough said.
They wouldn't dare make them up, because it makes them look like a bunch of fools who've got no idea what's happening. And that's pretty much precisely what they've been. If you go back to Ben Bernanke and his famous statement about how the deflation, making sure deflation won't happen here, and he talked about having a printing press that can produce money and rain it down upon the economy. What they do with QE is described as money printing, but in fact in no possible sense is it money printing. So they have a range of models about how the world operates which leave out the important variables. And to give you my most important variable in the economy, I think, is the level and the rate of change of private debt. Now, that was the basis of Irving Fisher's explanation for where the Great Depression came from. His theory was that there had been too much private debt accumulated prior to the Great Depression, combined with too low a rate of inflation. And then when the crisis hit, people were reducing their debts, and also as they reduced their debts, they paid their debts down in nominal terms, but GDP would fall further. And that was his explanation. So he focused upon the importance of too much aggregate private debt. Now, Ben Bernanke, who is regarded as the expert on the Great Depression, his consideration of Fisher was to say that Irving Fisher's arguments had no impact upon the academic profession, or little impact, because of the counter-argument that debt deflation represents no more than a distribution from one group, debtors, to another group, creditors, and without implausibly large differences in the propensities to consume between two groups. Pure redistribution should have no significant macroeconomic effects. Now, that load of waffle pretty much says we ignore the level of private debt because we don't think it matters, because private debt is just, Gordon lends money to Steve, Gordon's capacity to spend goes down, Steve's goes up, the two cancel each other out, no impact at all. That is completely naive about the role of banks in the economy, because you and I don't borrow from each other particularly, we borrow from banks. And when you borrow money from banks, you actually create money. When you borrow, what happens? Your debt goes up, which is on the asset side of the banking ledger. The bank's liabilities go up, which is where your deposit comes from. You then spend that money into the economy. So increasing the level of debt by using credit cards and loans and so on boosts economic activity. But equally, if you pay your debt down, if you have a crisis where you think you simply can't afford to carry the level of debt you've got, or you decide to pay your debt down, you actually reduce the amount of money in the economy. And therefore, changes in the level of debt directly change the level of money, which also changes the level of economic demand. So the level of debt private debt is an important indicator of how much accumulated errors we've made in the past we've carried forward to the future. And the change in debt is a major component to both demand and income. Now, what we saw with the financial crisis, the reason I saw the crisis coming, was I focus upon the role of debt, following the work on Irving Fisher and Hyman Minsky, and I saw the level, this exponential increase in the ratio of private debt to GDP. First thing I looked at was that ratio, and I thought it just can't keep on going, rising at that rate. At some point it will slow down, and because the change in debt had become such a major component of demand, since debt had got to be so big over the previous 40 or 50 years, when the rate of change of debt slowed down, then we'd have an economic crisis, which is precisely what happened. Now, that's the repression that I see really going on. It's the sheer weight of excessive debt on the economy. And after the crisis, that debt level's fallen from about 170% of GDP in America to 145%, roughly. You're now getting a recovery in the economy because people are borrowing money once more, but they're borrowing money from a level of debt which we've never reached beforehand in our history for a revival. So I don't think it can go on for much longer. I'd give this revival about 5 years before we're back to the level where, again, so much debt is taken on, people don't want to borrow anymore, they start deleveraging and will fall back down into a slump once more. And that's the situation Japan has been in for 1/4 of a century now.
Yeah, exactly. Now, you said 5 years, no more than. You think it's that far out?
Oh no, I'm just being I'm giving myself a bit of headroom. I mean, when you look back at when I started warning about the crisis, it was December of 2005 that I looked at the data again after a bit of a hiatus, working on other issues, and I had to do a law case as an expert witness on predatory lending in Australia, and then as a result of that, I looked at the level of debt to GDP. And I looked at the time series over the previous, as far back as I get the data from America, I could get data back to 1954. And I'd written this throwaway line in my legal brief saying that debt to GDP ratios have been rising exponentially, private debt to GDP. And I knew that as an expert witness, I couldn't rely upon hyperbole, which the barrister can get away with, but I couldn't. So I thought I'll go and take a look at the data. It won't quite be exponential. I'll need to attenuate my words, but it'll still be a rising level of debt. And then I just vividly remember looking at the data when I first plotted it, and my jaw hit the floor because it was a purely exponential rise in debt. And I thought this can't. Any unsustainable trend has to break. The level of debt was, looking at the American data, was greater than anything since 1954. And this exponential rise in the ratio over time, it had to stop growing. And I thought this is so big that when it stops growing, rather than just having a recession as we had back in the 1990s, we're going to have something resembling a depression, unless an enormous government stimulus comes in. So that's what indeed has happened. But we've now got ourselves to the same plateau of debt, which is the same thing that Japan's been on, from a higher level. And unless we reduce the level of private debt, we'll never have a sustained recovery in the economy. You've got to get that level of debt down, and I mean drastically down, down from where it is now, 145% of GDP, to say 50% of GDP. And then you can have a sustained revival. But because there's no direct attack upon the level of private debt, because the central banks are still ignoring this importance of private debt and trying to guarantee that creditors get paid rather than taking the pressure of debtors, we're going to be stuck in the same quagmire that Japan has been in for 1/4 of a century.
What should be done then?
I've argued for ages in favour of what I call a modern debt jubilee. I emphasise modern because if you look back at the classical debt jubilees, we've got some fantastic anthropological research on this, where people like David Graeber has popularised the book called Debt, the First 5,000 Years. But work by Michael Hudson in particular and Cornelia Wunsch, two experts that I know who work in the field, have said that if you look back at the ancient Sumerian civilization, which really so much of what we take for granted in human society came out of the Sumerian civilization, the wheel, domesticating the horse, writing, all these things have evolved in the Sumerian period. And the Sumerian Empire was defended by free men. Free men were formed the army. But of course, agriculture was the main industry back then. People would borrow money from money lenders to buy the seed they needed to put their crops down. If they didn't get this yield they needed, or they couldn't finance the debt, they'd become bankrupt. When they became bankrupt, they became debt slaves. and they then had to work on the property of the wealthy landowner. So there was this tendency for the level of debt to rise to a high level. Now, what it meant was people became debt slaves. They therefore couldn't be enlisted in the army, and the Sumerian Empire faced the possibility of being overthrown because it couldn't defend itself. Well, what do you think the Sumerian king did? He had two choices: lose the empire or execute the moneylender. Take your pick, goodbye moneylender. And then what happened regularly, this is well before the Jewish civilization evolved and also had its idea of a Jubilee, and then the Romans as well. But every 49 years, all debt was written off. And this was just known at that particular point, it would all go back to zero again. The debt slaves would be freed, they'd go back to their land and so on. So this tendency, debt up, down to zero, debt up, down to zero. And they realised the need to get rid of this level of debt. Now, fast forward, several thousand years to our times, what we have is people have taken on too much debt for real estate speculation, in particular during the subprime bubble, credit card debt. The main form of debt really is corporate debt, and then debt for the households largely for mortgages. And I argue in favour of a debt jubilee to reduce that debt level. But the comeback people say to me is, well, what about people who aren't in debt? If you write the debt off for those who are in debt, then you benefit them at the expense of savers. So what I call a modern debt jubilee is to use the capacity of the central bank and the government to create money and to put money directly into people's bank accounts, which the Federal Reserve does have the power to do, or it may have abolished that power in the so-called recent reforms, but Section 13.3 of the Federal Reserve Act gives it the capacity to do that. Give the money to people in a pro rata, per capita pro rata basis. And if you receive the money and you're in debt, you must pay your debt down, no choice. But if you receive the money and you're not in debt, then you get a cash injection, and use that capacity of state-created money to effectively cancel private debt and rebalance the economy from too much debt-based money, which is what we have right now, to more of a mix of debt-based money and state-based money, which is what we had back at, say, in the early 1960s, and return us back to the level. We can do it in several stages. I'm not arguing in favour of doing it bolus overnight, but trial it and see if we can reduce the private debt burden that way, because the only other way to do it is a long, drawn-out process of people going bankrupt over time, and we've seen in Japan that can take a quarter of a century, or what we did back in the 1940s. And I hate to say it, but the 1940s with the huge armament, build-up of armaments, fighting the Nazis, fighting the Japanese, that's what reduced the debt burden. We don't want to have a third world war to reduce debts this time round.
Also, a war would be fought completely different. It would, and as they always are in terms of cyber war and different methodologies. It don't necessarily expand a lot of capital. It could just consume a lot of financial.
Einstein put the perfect line about that. He said he had no idea what the Third World War would be fought with, but the Fourth World War would be fought with sticks and stones.
Precisely, precisely right. So, assuming we don't execute all the debt lenders, assuming we don't go to the approach that you just outlined, what is the likely scenario unfolding for investors?
Well, it's basically the economy is going to go through a series of short revivals followed by extended downturns, because that's the Japanese situation. And this is why I've written a piece recently for what's called Idea Economics, which is the 2015 outlook for idea economics. If you search for that on the web, you'll find it. And in that I said that I see the whole world as turning Japanese, but America in particular doing that. And by turning Japanese, I mean emulating the mistakes the Japanese made in 1990. And if you look back at the data, there's now the Bank of International Settlements gives us very good comparative data on private debt. And looking at that data, you can see that Japan had this huge long boom in what they call the bubble economy, huge amounts of money borrowed to speculate on real estate and shares in Japan, when the private level of debt peaked at about 225% of GDP in the mid-1990s. And since then, it's come down to about 175% of GDP. They've then gone sideways. And what you find is that the reason the Japanese economy hasn't fallen into a complete depression is that with the private sector not borrowing much money, the governments borrowed the money and tried to stimulate the economy that way. Government debt's risen from about 50% of GDP to 250% of GDP. But private debt has bounced around about the 175% mark. And what's happened is the government will run a stimulus, big deficit spending, increase its own debt. The economy revives a bit because of that. The government thinks everything's okay again, tries to get itself back into balance once more, and when it does that, the private sector starts to reduce its debt once more and the economy goes down. And they've been doing that now for a quarter of a century. And unemployment in Japan is 3 or 4 times the level it was back in the 1980s. It's still tiny compared to Australian American unemployment. It's about 5%. They have gone from the boom days when we used to have movies like The Rising Sun talking about Japan taking over the whole world to this sort of permanent stagnation. And I can see America being in the same situation unless it deliberately reduces the level of private debt.
Steve, last question for you as we break here. Time this airs on YouTube, Draghi will have made his announcements with our expected potential European version of quantitative easing. We've just finished here with the Swiss taking themselves off the euro peg. Could you shed some light on any of that? What do you think is...
QE itself is something which people mistakenly call money printing. And they'll say, the government, they're printing this huge amount of money. No, they're not printing money. If I give an analogy, if you imagine, like if printing money was like printing oil, or printing gasoline, then what they're printing is lubricant oil. Okay, they're trying to fix the economy by pouring, rather than putting petrol in the tank, they're putting lubricant on the cylinders. Mm-hmm. Because what they're doing quantitative easing, the central bank is buying bonds off the private banks. Okay, so that's the private banks produce mortgage-backed securities. The central bank then buys those mortgage-backed securities off the private banks. What that means is the private banks are encouraged to produce private debt in the form of mortgage-backed securities and sell that to the central bank. So that encourages them to be producing debt to sell to us, to produce mortgages. Okay, so it's giving mortgage finance, but it's increasing the debt level of the private sector. Mm-hmm. It's not, if you're printing money, you'll not be getting $1,000 checks in the mail. We're not. That's not what they're talking about by Draghi's idea. That's not what the Federal Reserve has done. So consequently, the only thing that can boost is not demand for you and I for books and and coffee and automobiles and stuff like that. All it can do is boost demand for other financial assets. So what QE has done is push up the asset markets, but it's done very, very little for the real economy. The amount of money they've pumped in is gigantic, but it's all basically boosted asset prices. It hasn't actually done much to boost private demand. It's had a bit of an impact, but nothing like the impact you could get if you did what I'm talking about, which colloquially people call a helicopter drop. Drop your money over onto the real economy. That could boost the economy. That would be money printing. That's not what QE is. So that is a false vision. Now with what's happening with the euro, the euro was always an economic mistake. It was never a sensible idea, and the reason is that when you form a currency union, like making the whole of Europe a bit like America, the only way that can work if you also do what America does, which is have a central treasury that means that the taxes they raise in California get spent propping up income and lifestyles in Alabama, and everybody accepts that because you're all American. Okay. Well, the Europeans built a central bank, but they didn't build a central treasury. And so consequently, if there's a surplus in Germany and a deficit down in Greece, there's nothing to make the conversion between the two. Now, normally what that would mean is that Greece would have to devalue compared to Germany, but by having only one currency, they can't devalue. So the euro is always a mistake, and it's now being manifested as a mistake by this crisis. But at the same time, it's a mistake that the Europeans are wedded to politically because they think it's part of the drive for unity in Europe after the horrors of the Second World War. Well, I think it's actually more likely to bring it back to the same fragmentation that led to the Second World War in the first place. And we're now seeing a rise of nationalism again in Europe. And I think the best thing that would happen there would be, after the Swiss have done a little bit of pulling out of supporting the euro effectively by removing their peg, I'd like to see the Greeks exit the euro and we just abolish a huge part of the private and public debts that are over there and reset the whole system and get away from the euro.
Are you alone, or is there a large amount or a larger number of the academic community beginning in economics supporting your views?
Oh, well, twofold. I mean, it seems like the euro, there's probably more support for what I'm saying than most other things. In terms of the arguments about taking a monetary approach to analysing capitalism, yes. Ironically, there's only a tiny fraction of economists who are doing that. And people like Paul Krugman and Ben Bernanke are trying to block analysing capitalism as a monetary system. Now, that might sound ridiculous to people who aren't economists, and frankly it is ridiculous, but the majority try to avoid thinking about the monetary system. So it's minority groups like what they call modern monetary theory, Stephanie Kelton being a major actor in that area. There's another German-derived academic based in England, Richard Werner, who does a lot of work on the importance of debt. There's Morris Schulrich has done some fantastic empirical work. You've got a brilliant philanthropist in America, Richard Vague, has published a great book about the next financial crisis, what to do and how to stop it happening. So there are certainly people who are taking action here. The Bank of International Settlements is also trying to build a monetary analysis of capitalism, but we're pushing against the mainstream that completely ignores the role of banks, debt and money in capitalism. So it's a strange situation to be in.
We have to wrap. Any message you'd like to leave with our listeners, Steve?
Basic message is don't trust the economists. Okay? We normally, if you go to the dentist, you trust the dentist knows what to do about your teeth. If you drive over a bridge, you're implicitly trusting the engineer who built it. That's all justified. Those are areas where expertise has been tested by empirical reality. I think the financial crisis should have been a lesson to people that economists aren't experts on the economy, and start to look for the critics and the people outside the mainstream, like myself, but there are many others apart from me. That's where you're more likely to see sense and help us overthrow this naive vision of capitalism, the dominant vision, which is really more about ideology than it is empirical reality.
Very well said, and I happen to very much agree with you on that. We have to wrap. Can you tell our listeners how they could follow more of your work and your writings?
Yeah, well, actually, I've now just this week actually started blogging on Forbes magazine.
I saw it.
You go to Forbes and search for Steve Keen. There you'll find me as a contributor. And the first piece I've got there will be a bit of a paradoxical one. I know a lot of people would be in favour of governments running surpluses. And I point out that for a government to run a surplus, it means its taxation has to exceed what it spends out in benefits on you. So it's getting a surplus, which is increasing its savings, involves reducing your savings, unless you go into debt to the banks. So in fact, running a government surplus, the mirror image is what affects the public, and it means the public has to run a deficit. And that isn't a good idea. So I'll explain a bit of the logic there. So go to Forbes and I'll be writing about Forbes from now on.
A surplus can be as bad as a deficit. Balance.
In fact, the deficit is a better idea, because my analogy for the government is to think about the government as being like a bank. A bank actually, in effect, runs a deficit by putting out more in loans than it gets back in repayments. And that money then lets us do economic activity. It generates the capital and the turnover. The government has a similar role. And until we get our heads around that, we're going to be putting ourselves in regular financial crises by trying to treat the government like a household that should try to hold a surplus, and that actually is a contributor to the economic crisis we're in now.
Steve, thank you very much. I very much appreciate your comments and your honesty, and I think our listeners will really enjoy it. So we'll talk to you again sometime in 2015.
That'd be great. Okay, good to meet you and good to talk.
Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.